Imagine a country with no strong financial safety net, no central bank strong enough to step in fast, no system able to stop a panic in time. Now imagine that in those moments, when the economy was shaking, one man made the calls. One man decided which banks survived and which failed. One man sat behind closed doors and told the most powerful people in America what to do next. That man was J.P. Morgan. He was not elected. He held no government office. But at key moments in American history, the economy depended on him. He built giant corporations, reorganized industries, rescued the U.S. government from default, and helped shape the financial structure of a nation. John Pierpont Morgan was born in 1837 in Hartford, Connecticut, into a family already tied to money. Morgan's childhood was not ordinary. He suffered serious illness, spent long periods in isolation, and grew up around discipline and pressure rather than warmth. He had privilege, education, and security, but very little peace. His father wanted him to become a financier. So while other young men chased ordinary lives, Morgan studied financial systems, spent time in Europe, and learned the mechanics of money deeply. He later served his apprenticeship in New York before founding his own firm in 1864. From the beginning, his life was shaped by one drive: bring order to chaos. Morgan entered banking young and quickly showed he was willing to take risks others would avoid. One early move involved a ship full of coffee. Without permission from his employer, Morgan bought the cargo and resold it for profit. It was bold, unauthorized, and successful. It showed the style he would use for the rest of his life: act fast, trust his own judgment, and move with confidence. During the Civil War, Morgan avoided military service, yet records show he profited from war-related business. It was legal at the time, but it revealed something important. Morgan understood that capital follows opportunity, not conscience. By the late 19th century, railroads were the backbone of the American economy. They connected cities, moved goods, and powered growth. But the industry was chaotic. Too many competing companies, too much price cutting, too much debt. The system was unstable. Morgan saw the real problem. It was not a lack of capital. It was a lack of structure. He developed what became known as Morganization. He would take a failing railroad, convert debt into equity, install professional management, and merge competing lines to end destructive price wars. He did not build the tracks or run the trains. He reorganized the power around them, and in doing so, he controlled much of what moved on them. Railroads showed Morgan's method. Steel showed his ambition. In 1901, Morgan arranged the largest corporate transaction in American history at the time. He bought Carnegie Steel from Andrew Carnegie for $480 million and merged it with other producers to create U.S. Steel, the world's first billion-dollar corporation. At its start, U.S. Steel controlled nearly 45% of American steel production and owned much of its supply chain, from ore in the ground to ships carrying finished metal. One company, one chain, enormous control. His strategy never changed: combine, control, dominate. He was not interested in small victories. He wanted ownership of systems. In 1895, the U.S. Treasury was in crisis. Gold reserves were draining, and the country was close to default. The government was nearly out of the gold needed to back its currency. Morgan stepped in. Using an 1862 Civil War-era legal mechanism that allowed President Grover Cleveland to bypass Congress, Morgan's syndicate supplied 3.5 million ounces of gold directly to the Treasury. The government's credit was restored, and the crisis passed. Then came 1907. By 1907, the panic had shown how fragile the system was. A failed attempt to corner United Copper stock helped trigger a run on Knickerbocker Trust, and the fear spread quickly through New York. With no Federal Reserve and no official rescue mechanism, Morgan became the man everyone turned to. He personally examined distressed firms, decided who would live and who would be left to collapse, and raised $23.6 million in only 16 minutes to steady the stock exchange. Then, he brought the city's top bankers into his private library and made them agree to fund a final rescue before they could leave. That single night captured the scale of his power. One private citizen, no public mandate, yet enough influence to force coordination at the top of American finance. The story of J.P. Morgan is not simple. Some saw him as indispensable, a man who brought order to chaos, stepped in when institutions failed, and helped build the infrastructure of a modern industrial nation. He created stability where there was none. But others saw something more troubling. He did not just bring order, he also created monopolies. He crushed competitors. He profited from crises he helped resolve. And he did it all as a private citizen, accountable to no one but himself. President Theodore Roosevelt understood the danger of that concentration of power. His administration went after Morgan's Northern Securities Company, a railroad holding company formed to consolidate control over major rail networks in the North. Roosevelt won, and the company was ordered to dissolve. Congress launched the Pujo Committee investigation, targeting what critics called the money trust, the idea that a small group of Wall Street financiers controlled the U.S. economy. Morgan was called to testify. When investigator Samuel Untermeyer asked whether money and credit were the main foundations of commercial power, Morgan replied, "The first thing is character before money or property or anything else. Money cannot buy it." Some associates later said the stress of that hearing damaged his health. Morgan died in March 1913, just months later. His era was ending, but his legacy was only beginning to be understood. The instability exposed by the Panic of 1907 convinced Washington that the country could not keep relying on private individuals. A secret 1910 meeting at Jekyll Island, attended by, among others, Morgan partner Henry Davison, helped produce the blueprint for a National Reserve Bank. President Woodrow Wilson signed the Federal Reserve Act in December 1913. The first president of the Federal Reserve Bank of New York was Benjamin Strong, a former Morgan lieutenant. That influence helped create the Federal Reserve, and later reformers moved again with Glass-Steagall in 1933, forcing banking to split apart. Morgan's reach faded, but the structure he helped build kept shaping finance for decades after his death. Later, the Glass-Steagall Act of 1933 forced the firm to separate commercial and investment banking, leading to the creation of Morgan Stanley in 1935. In 2000, J.P. Morgan and Company merged with Chase Manhattan Bank to form what we know today as J.P. Morgan Chase, a firm with trillions in assets and a global workforce of more than 300,000. J.P. Morgan built empires, rescued markets, and frightened governments. He proved something many people sense but rarely say aloud. Money does not just follow power. Money creates power. And when enough of it concentrates in one place, entire nations begin to orbit around it. He is gone, but the structures he built remain. The debate he sparked is still unresolved. How much power should any one institution hold? When private capital saves a public system, who does that system truly serve? Morgan left behind no clean answer, only a sharper version of the question. So tell me in the comments below, was J.P. Morgan a genius who saved America from itself, or a danger hiding behind the image of a solution? Drop your answer below. And if you want more finance history like this, subscribe. The real stories of the people who controlled the money are often more compelling than the headlines ever told you. A question still open.